Hello and welcome to the Currency Exchange, where myself, Eimear Daly, and NatWest Markets team of FX strategists help to break down the major themes and events driving currency markets this week and in the weeks ahead. Today I'm joined by none other than Paul Robson, who was our European G10 head of FX. And I guess at the moment, we are still talking about, relative central bank policy. We're definitely pivoting towards that easing narrative. However, some central banks, they're not yet done with the tightening cycle. We have just had the ECB policy decision, but next week we have another raft of developed market central banks with the Fed, the Riksbank, the Nordic Bank, and the BOE set to deliver their hiking cycle. It was quite a response, almost counterintuitive, that we got from the ECB today. They did hike by 25 basis points against market expectations, but perhaps the euro's reaction wasn't what we were expecting. Well, what did you take away from the ECB decision and the euro's response to it?
Well, I think if you look at the euro's response, the overall decision was dovish, and I think that's the right interpretation. So a dovish hike from the ECB. It was always going to be finely balanced whether they were going to do a hawkish hold, so hold rates, but sort of talk about that there might be a need under certain conditions to continue to tighten, or to hike and sound a little bit more dovish about the outlook. And in the event, they hiked rates, but they were actually really quite dovish. Really, I think just by signalling that the policy rate at current levels, after they raised it by 25 basis points, would be sufficient to get inflation back down to target if it was held at that level for a sufficiently long time. Now, we can talk about how long sufficient is, and only time will tell, and the data will inform on that. But the idea that the ECB is now finished, it just means that markets then can start thinking about what the next sort of easing cycle is from the ECB. And I think that was the sort of main takeaway. I think it was actually very similar to what we've been hearing from the Bank of England over the last couple of weeks. They've obviously got their own meeting next week. We think they go 25 basis points. But what the governor of the Bank of England has been saying, and sort of backed up by the chief economist, Hugh Peel, is this idea that, may get one last rate hike, but rates are going to be plateauing for some considerable time. And he talked about table mountain in terms of policy. And that's exactly what the sort of ECB was talking today. How do you get from that tightening cycle to the easing cycle with making sure that the monetary policy tightening that you've already achieved continues to work on the economy? And this is what today's meeting was about. In terms of the euro's reaction, as I say, I think it was right. If you think about the drivers of euro dollar, you've got two extremes, sort of big picture. You've got relative growth between the rest of the world and the US. And as that shifts to the rest of the world, the dollar tends to go down, euro dollar goes up. Maybe it helps the euro area economy in terms of overall demand. But sort of month to month, week to week, euro dollar is essentially a monetary policy currency. It tracks very tightly short-end rates, the sort of slope of the curve. European government bond spreads are all important. If you look at today's policy decision, markets trying to firm up what that easing cycle looks like, they can take out some of the premium out of some of the curves. It suggests that the euro dollar should be weaker. But I think now the focus will turn to other central banks and whether they're close to tightening. I mentioned the Bank of England, got the Fed next week. It's a similar kind of story. And from here, I think euro dollar is all going to be about, that timing of that first rate cut, the speed of rate cuts, and ultimately the depth. And that's where we are today, I think.
And I mean, pivoting from that point, we've got the Nordic Bank and the Riksbank next week. What are the growth inflation dynamics that they're facing, and how far away are they from the end of their tightening cycle and the start of policy easing?
Yeah, I think they were just a little bit further away than the ECB and, in fact, the Bank of England. So I think next week's rate decisions from the Riksbank and Nordic Bank are going to be very similar to the ECB but different. And the difference is going to be about the guidance. So we expect a quarter point rate hike from both of those central banks. Inflation is sort of easing somewhat, but it still remains uncomfortably high. And their previous guidance was that if economic developments essentially continuing in line with their forecast, a rate hike would be needed. So both in the last set of monetary policy reports, they sort of pre-committed to raising rates one more time. And if you looked at the expected rate path for both those central banks that they produced themselves, it was consistent with 25 basis points. So I don't think that's going to be the major surprise to markets for the next week. Where markets will be focusing on is guidance for the next meetings at the back end of the year, so November and December. And here, the crucial focus will be not on headline inflation, which is coming down, and a weakening economy as the sort of tightening cycle exerts, but the idea that core inflation is still very uncomfortably high at sort of running around 6%. So the fall in inflation is really just the base effects on energy and not underlying price pressures. And that suggests the central bank has a little bit more. Where there's also a difference between the ECB and the Nordic central banks is on the currency, because they've been very sensitive to weakness of the currency at a time when inflation is high and the pass-through importing inflation. And both currencies have been very weak and has attracted the attention of the central bank. And as we know, the main policy support for a currency is probably higher rates. Now, both currencies have been, I think, hurt by the interest rate differential between Sweden and Norway versus the euro area. And it feels like both those currencies need quite a decent interest rate premium to gain against the euro. And that's been eroded. There's some other issues around commercial real estate, just house, residential real estate as well, and the ability of local banks to lend. And that's seen people speculate that the currencies continue to weaken. So if you put all that together, it feels like the central banks will want to take out a little bit of insurance. Now, next week, both Norway and Sweden publish monetary policy reports, and they have that expected rate path projections, and they could use that as a signal for saying that unlike the ECB, they've still got a little bit further to go, because they want that premium to get a little bit larger before they say that they're done tightening.
It's interesting, there's such a contrast between what's happening, in developed markets, Europe, and in emerging markets. So in my kind of region of coverage in Eastern Europe, almost central banks have been vindicated by their past policy actions. They were out on the front foot. They started hiking, as early as the first half of 2021. And that is because, as an emerging economy, they were more susceptible to global inflation factors we saw. So obviously, as a poor nature, food prices and energy prices matter more, and they push inflation higher. But they're also very susceptible to currency weakness, really, importing inflation into their economies. They hiked aggressively, but that meant that inflation consistently printed lower since February of this year. And that means that, as the global, economic environment faces these headwinds of a global manufacturing slowdown, of anemic growth coming out from the Eurozone, that actually they're able to provide counter-cyclical policy. They can start cutting while their economies are flatlining. So we have, already had 2 out of 3 of the C3 central banks kind of initiate their policy easing. And we're forecasting that the third, the Czech Republic, will start policy easing from November. And I get, that very clear divergence of, still sticky inflation in a number of developed markets. And thus, central banks having to maintain higher interest rates for longer, versus in a number of EMs, they're able to start cutting. The result is they're undermining that really lucrative carry that they're offering investors. It's just very clear for us that, high carry EM currencies will trade lower against, such currencies like the euro and the dollar. So we do we are looking, for Brazilian real, the Chilean peso, but also Polish zloty, Hungarian forint to trade lower. On this kind of theme of when exactly will developed markets you'll be able to begin easing, we had quite an interesting print this week, which was US August CPI, and it printed higher than expected, just marginally, and it looked like the market was willing to overlook it. I guess, Paul, what is your take on this? Does it push that point away even further for the US Fed to start the easing cycle?
Yeah, I think it does for me. I think just overall data resilience in the US and this idea that inflation's not quite coming down as quickly as I think you used the word market sort of hope, because that is important for a whole range of assets, isn't it? That does inflation come down quickly enough for central banks, including the Fed, to cut interest rates against the backdrop of weakening economic growth? And if inflation stays higher for longer, central banks are going to be more reluctant to cut interest rates, and then it's just a much more sort of adverse environment for a whole range of risk assets, and the dollar just stays a little bit stronger for longer. And I think the euro dollar move that you've seen today sort of reflects that sort of stronger data again, activity data in the US on a day when the ECB looked to signal that they're not tightening anymore, has pressured euro dollar lower. So when we think about euro dollar, I think we do trough around 105. I think the market will increasingly shift on, okay, we now know what the ECB has done. Let's see what everyone else is doing. But that timing of that first Fed rate cut, and as I say, the speed, the depth, is going to be the number one thing for FX markets next year. And I think positioning for the global easing cycle is going to dominate all our attention next year. Ultimately, I think it's currencies that have done worse in the tightening cycle are the ones that probably do the best as everyone else eats. And so the yen looks front and center there. The other one is I talked about Norway and Sweden, about how they've been sensitive to currency weakness because of the impact of importing inflation. One other area that's sort of been a similar kind of situation is Switzerland, and the S&B acting to keep the currency strong. It'll be very interesting to see when inflation pressures start to ease, and they stop that. Is Swiss franc weakness one of the big things for next year? And on that, we'll be updating our thoughts later in the year with our year ahead for 2024. Time seems to be going very, very quickly at the moment.
Which will be all about relative central bank policy and inflation dynamics. Paul, thank you so much for joining me again. And that's about all we have time for. So do make sure you subscribe to the podcast if you liked it. And remember to click like so you can find the next podcast first. Thanks again. Goodbye.